Hi everyone, I'm Sharin. I'm a student of economics in the Faculty of Economics in UM. And for the Bedah Buku session, I've picked the book called Intelligent Investor, written by Ben Graham. So the reason why I picked this book is primarily because as a student of economics, I think that the vast majority of us ought to be interested in financial management or to collect a certain pool of wisdom and develop our financial wisdom so that we're able to be financially stable as soon as possible. Given the fact that we also study economics, it's heavily related to finance and how to manage the resources that we have at our disposal. Right? So some background about the book. The Intelligent Investor was written by Ben Graham. So Ben Graham is a professor of business and finance. He was active in the first half of the 20th century. So this would mean that he was a professor there between the 1930s to the 1950s. He was a professor at the Columbia Business School in the USA, and he was a teacher to Warren Buffett. And Warren Buffett, as we all know, is a very famous billionaire, number 3, the third wealthiest person in the world, right? And Warren Buffett actually recommends The Intelligent Investor as the number 1 book every person interested in investment should read, right? Okay, so, and anyone who's interested in investment, even like people who wish to pursue investment banking, like this book is recommended to them as a starting platform for them to learn the basic fundamental principles that goes behind investment and investment banking, right? So this session will be extracting the most important fundamental insights from this book based on my readings and sharing it with all of you. Okay, so I'm going to section this session into a few parts. First, I'm going to talk about the first principle that he introduced to us, meaning the difference between investment and speculation. Secondly, I'm going to talk about the types of investors. There are 2 types of investors and what constitutes each type. Thirdly, I'm going to talk about inflation and how that would influence investment behavior. Fourthly, how to analyze bonds and stocks. And lastly, I'm going to talk about the margin of safety very briefly. Right? So all these terms that I'm using might seem, you might be familiar with these terms depending on your background in finance. You might not be familiar, but I will try my best to define them so as to make it a lot more, so as to accommodate to your level of understanding, regardless of your level of understanding. Even if you are not a student of economics or finance, I do think that you will find this session on this book very useful for you moving forward if you want to manage your finances and you want to pursue investment a lot more deeply from this point onwards. Right? Okay, so firstly, in terms of investment versus speculation, right? I think it would be best for me to define speculation before defining investment, because I think we all are somewhat familiar or have been exposed to what investment banking or stock trading would look like, especially in media, especially the ones depicted in Hollywood movies like Wolf of Wall Street or Wall Street Money Never Sleeps, for example, like the movie where Shia LaBeouf acted in and with Michael Douglas, right? So in these movies, what happened was we had all these, sexy suit wearing stockbrokers working in skyscraper buildings, working on computers with complex numbers and whatnot, and making millions and billions off just a single trade, right? And a lot of us actually think this is what investment actually looks like, but this is only a very exclusive, very unrealistic picture that Hollywood painted for us. And this is actually what speculation looks like. So a lot of people who work in Wall Street and who work in hedge funds, for example, that read the news, for example, like, oh, the price of petrol has increased by X amount, and therefore executes a certain trade to sell the petrol commodities that they have to make millions, for example. These are the people who work on the basis of speculation, meaning they read a certain rumor and then they make money out of that certain rumor, right? So So speculation is actually not an ideal form of investing. It's not the correct way of investing as posited by Ben Graham. Primarily because speculation is very risky, right? Investment, which is what Ben Graham emphasizes on in this book, is putting your money in something that will promise you the safety of the money that you put in, meaning you can, whatever money you put back, you will definitely get that money in with adequate amount of returns. Meaning, like, you have a certain target in terms of how much money you want to make by investing in a certain stock or bond, and it's highly likely that you will get back the return that you wanted, right? So meaning, if you want 20% return on this stock or bond that you invested in, you will definitely get it, along with the money the principal that you invested in. Principal meaning the money that you put in, you will also get back the exact same amount, right? And on top of that, you get returns. Speculation is anything but this. Meaning, speculation means you are engaging in high-risk behavior based on a rumor that you don't know that you're going to get back your return. You don't know that you're going to get back your principal or your returns. And this is something that we as students or wise investors would want to avoid, right? So we're gonna go into a break. After the break, we're gonna talk to you about the different types of investors and inflation, and lastly, we're gonna talk about how we should analyze bonds and stocks. And the difference between defensive and enterprising, in my opinion, is a defensive investor doesn't always have to keep checking on his stock or bond accounts and don't always have to keep up with the market updates. I kinda like you. Right, welcome back, guys. So previously I introduced to you the difference between what an investment means and what speculation is, right? So as an investor, one of the basic things we want to do is to avoid speculating, meaning we want to avoid reading the news and reading rumors too much and basing our investment decisions on the news that we read, right? So with that, let's set that aside, let's keep that in mind, and let's delve into the other elements of investing that Ben Graham wanted to talk about. So he said that in the book, he mentioned that there are two types of investors. So if you want to pursue investing, like, you don't need to pursue it as a career. So you can also do it as a part-time thing, right? So you can invest your money and you can be interested in investing even if you have a full-time job that's not related to investment at all, right? Okay, so two types of investors. So the first type is called a defensive investor, and the second type is called an enterprising investor. So what is a defensive investor? It's quite self-explanatory. A defensive investor, as the name suggests, is an investor that's more conservative, that's more careful with the person with your investments. So meaning you prioritize the safety of your principal, meaning you definitely want to get back 100% of what you invested in it. So the money, if you put in 100 ringgit, you want to get back 100 ringgit. That's your priority. And you also want to get some amount of returns. That's not necessarily a priority, but some amount of returns is enough for you if you're a conservative investor. And the difference between defensive and enterprising, in my opinion, is a defensive investor doesn't always have to keep checking on his stock or bond accounts and don't always have to keep up with the market updates, right? So this brings me to the next type. If you're an enterprising investor, you still want safety of your principal and you want more returns than defensive investor, but you are an enterprising investor, as the name suggests, because you're willing to put in more effort in keeping in touch with market updates and constantly checking to maximize your returns, right? So this very simple definition, very simple difference. Okay, next, let's talk about inflation. How does inflation influence your investment decisions? As we all know and we've learned in economics that inflation is something that happens consistently and happens every year, and it's quite rare that an economy slips into deflation. Like Japan is one of the very few countries that is currently in deflation, but the vast majority of economies in the world are in inflationary cycles, right? So because inflation happens, and usually inflation is 2 to 5% depending on the state of the economy on average, right? So because there are two types of investments that you two types of investment products that you can put your money in. One's called bond and one's called stock. A bond is basically government. When the government wants money, they will sell bonds to you and they will pay you back the money that they owe you plus interest, right? Stocks, on the other hand, you buy a company's stock and you get to own a certain percentage of the company. So during inflationary cycles, it is said, Ben Graham told us that in this book, that bonds are a bad investment because it badly protects you from it badly protects you against inflation, primarily because bond returns are very low, or rather they are lower than inflation rates in general. So therefore, he told us during inflationary cycles, especially high inflationary cycles that happens most rampantly during periods of high productivity, we should opt for stocks because stocks outpace inflation 70% of the time, or we should invest in REITs, basically real estate investment trust funds, right? So basically companies or funds that own a lot of property that you collect rent from, right? So if you're interested in investing and if you're an investor in an economy during a period of inflation rather, these are the kinds of investment options that you should look at according to Ben Graham. Next, so how do you analyze bonds and stocks? So Ben Graham in this book emphasized mostly on investment decisions concerning bonds or stocks. So like bonds meaning government issued, stocks company corporate issued, right? So with regards to bonds, the most important determinant is actually the number of times the earnings of the utility company that issue the bond can cover interest charges. For those who are not familiar with finance, earnings basically means how much the company earns through selling its services, and interest charges is basically how much the company borrows and the interest charged on the amount of money borrowed from whoever the utility company borrowed from. So the number of times the revenue of the utility company can cover the interest charge on the money they owe, that is so a healthy number would be 5 to 7 times, right? So if the utility company matches that criterion, then that is a good bond to buy. Secondly, stocks. So a good way to measure whether a stock is good or not is to look at its future potential earnings. So to measure the potential earnings, you should look at the financial statements, so the cash flow statements, your balance sheet, and your statement of your income statement, right? So based on the information that you have, you find out what the average future potential earnings, and then you determine what is the percentage of rate of return you want from this stock in this company, and then you make sure the average actually matches the required rate of return you want, right? Okay, so how do you determine how much you want to invest in a stock? I think this is the most juicy part in this book, in my opinion, right? So Ben Graham said that we have to look at two primary things, in my opinion. So firstly, he said that we have to look at the long-term prospects of the company. So you take all the reports, and then we have to look at the red flags of a certain company we want to invest in. The company is a bad company to invest in if their serial acquirers. Serial acquirers means they always want to buy stocks of other companies and they want to acquire other companies, right? So they acquiring other companies means they don't believe in their own company, meaning like buying stock of that company is a bad investment decision. Secondly, companies that borrow a lot and sell their own stocks to raise money for their own selves. These companies are also unsustainable primarily because they are reliant on debt and alternative sources of financing. Thirdly, companies that are reliant on just one customer. So these companies have one big client that gives them a lot of revenue. These are also bad companies to invest in. Instead, what we would want are companies that have strong brand identities, companies that have monopolies or near monopolies, companies that are low cost or resistant to substitution. Resistance to substitution means that, for example, electricity, there's no substitute to electricity just yet. Therefore, utility companies is possibly a good investment to invest in. The second thing he told us to look at is management competency. So like if a company has good managers are managers who admit their failures and take responsibility. These are the companies that we want to invest in. Those who also produce transparent financial reports, who don't produce suspicious expenses and charges, for example, right? So that very briefly encapsulates the very strong, very pronounced insights of The Intelligent Investor by Ben Graham. Just a personal sort of advice to those of you who wish to pursue investment, or those of you who wish to embark on a journey towards financial stability. If you're interested in investing in stocks, there's a lot of blogs you can go to study about stock trading. So the first thing you need to do is open a CDS account, if I'm not mistaken, and basically Maybank CIMB allows you to do so. So you can open a stockbroking account and then you can analyze stocks and bond options, and then you can determine which stocks or bonds you want to buy, right? So and before you embark on said journey, I strongly recommend The Intelligent Investor by Ben Graham to know what the basic principles of investing are, and you can apply them in your journey. Thank you.